Groovy. Okay. Well, welcome, guys. This is chapter 5. We have one more chapter before our midterm. Next week in class, I will provide the study guide prior to class. I will send it to you guys. I'll post it in discussions. And the midterm is just all multiple choice. We'll go through it. I'll be honest and tell you that a lot of these questions will be just like what the study guide is. So I'm not going to necessarily give you the answers because you're going to probably see that exact question on the quiz or on the exam. But at least you can find a way to figure it out and work with others to figure it out. Again, you can work with people on your study guide. You just can't take the quiz with someone else. Got it? You can also use open books. You can do whatever you want. You just have to do it yourself. That's the only key. Does that make sense? Okay. Chapter 5. Today, we're talking about receivables, which is an asset, and sales, which is part of the revenue income statement. So credit sales are what creates the accounts receivable. A credit sale is when we sell or transfer products or services to a customer, but we don't get the cash right away. We want to get the cash down the road. I'll do this so then if someone comes in, I'm looking better. We want to get the cash down the road. We can call this sales on account or services on account. And this is very common for a lot of business transactions. It can also be called trade receivables when you sell items to a customer, but they don't pay you right away. When the transaction happens, we record it as a revenue because the event occurred. But since we haven't received the cash, we debit accounts receivable and we credit our revenue. So here's our little Lynx dental charge. Charges $500 for teeth whitening. DK decides to have her teeth whitened on March 1st, but she doesn't pay cash at the time of service. She promises to pay the $500 whitening fee to Link by March 31st. So since the service occurred, the dental office will debit accounts receivable and credit the service revenue at that time. Remember, when this transaction occurs, we record an asset called accounts receivable and we credit revenue when a company sells products or services to their customers on account, planning they're going to get money in the future. There are other types of non-trade receivables, tax refund claims. We already have talked about interest receivable, loans receivable, like a note receivable. So there's all kinds of different receivables, but we're really going to focus on sales receivables today. So guys, first question of the day. Which of the following are sometimes called trade receivables? And don't all answer at once, you know. That was a joke.
Is it A?
I'm sorry.
Is it A?
You are so, who was that who answered that?
Mohammed.
Mohammed?
Yes.
Mohammed, you are right. Okay, so I can start calling on Mohammed when no one else wants to answer. Okay, awesome, Mohammed. Now, along with our revenues and talking about accounts receivable, we're going to bring in some other types of accounts today that will complicate this a little bit. Not hard though. Companies often offer discounts that can reduce the amount of cash the company is entitled to receive from these customers. We're going to talk about what's called trade discounts, sales returns, sales allowances, and sales discounts. All of these items come into play of what our revenues really are going to end up being. The word net revenue is really going to be our revenues minus any amounts for returns, allowances, and discounts. Now, the term trade discount is just really saying, hey, we're going to offer this product for this amount. We're giving everybody, instead of $500 of teeth whitening, we're going to give it to you for $400. It's just a reduction in the list price. It's used just to incentivize people to purchase. And guys, sometimes it works. I'm getting into, I know it's goofy, my latest hobby is crafts, making quilts. And so I'll go into one fabric store online. They say 40% off all the fabric. And you just jump and go, wow. But then sometimes if you just really compare, their 40% off is like someone else's normal price. So it is an incentive to shop. Because sellers are only entitled to receive the discounted amount, we don't record the sale at the list price. We record it at the price it's being sold for or offered for. So in this example, FYI typically provides laser surgery for $3,000. But in the month of March, they're offering it for $2,400. So when the company provides the service, they are going to show accounts receivable for $2,400 and service revenue for $2,400. They're not going to show the $3,000 because that's really not what they're selling it for. They're telling them it's $2,400. So with this, sometimes someone has purchased a product and they're not happy with it. They can return it. This is when customers return goods that they previously purchased. In that case, we'll back out the revenue and we'll back out the accounts receivable. But sales allowances can be when someone doesn't return goods, but they issue them some type of allowance because they're not happy, okay, with it. So here's an example. On March 2nd, FYI, sell sunglasses. Well, this isn't this exact, this is returning goods. Sell sunglasses to a customer on account for $200. On March 4th, the customer decides she doesn't want the eyeglasses and receives the full credit. So in that case, do you see I told you it was revenues. It's a debit to sales returns, but we zero out our accounts receivable. We show the sales returns so we can keep track of how many people actually return products. Now, here's an example of an allowance. The customer having laser eye surgery on March 1st for $2,400 is not satisfied with the outcome of the surgery. On March 5th, FYI allows a $400 reduction in the amount owed by the customer. The company records it as a debit to sales allowances, and it reduces their accounts receivable. Does that make sense? Students sometimes misclassify a contra revenue account, which is what these are, as an expense. Like expenses, contra revenues have a normal debit balance and reduce the reported amount of net income. But contra revenues aren't a cost of doing business like an expenses. Contra revenues represent reductions of revenue, where expenses represent cost of generating revenues. So what we're talking about with these sales allowances, sales returns, these are going to be up in the revenue section as a contra account to revenues. Here's another contra account, sales discounts. Reduction in the amount to be received from a credit customer if the collection on account occurs within a specified period. So for example, if when a customer buys something, the terms of the purchase say 210 net 30, what that means is if the customer pays their bill within 10 days, they get a 2% discount. Otherwise, the entire bill, the full bill, is due within 30 days. So this type of term in a purchase, it's a way to communicate the amount of the discount and the time period with which it is available. The term 210 indicates the customer will receive a 2% discount if the entire amount is paid within 10 days. Net 30 means if the customer doesn't take the discount, then the full payment is due within 30 days. So here's an example. FYI typically provides laser eye surgery for $3,000. The company offers laser eye surgery in the month of March for $2,400. FYI provides laser eye surgery to the customer on March 1st for $2,400 on account with the terms 210 net 30. Cash is collected from the customer on March 10th. So the customer or the company is going to record a debit to cash of $1,960. The discount, the 2% of the $2,400 is $40. And the entire accounts receivable gets credited for $2,000. Does that make sense, guys?
I have a question.
Yes.
Okay, so why would the whole accounts receivable be credited when you just receive cash? Wouldn't it just be 40? So you would remove the sales discount?
Well, she was supposed to pay $2,000. But, I'm sorry, why is the whole thing, why isn't the accounts receivable reduced by 40?
No, like why isn't it just 40? Like, because you received cash. So why would you put accounts receivable as a credit when you already received 1,960 as cash?
Good question. How much does she really owe though? If she takes advantage of the 2% discount, then the company's saying to her, you only owe $1,960. So she paid the $1,960, and that's why we debit the sales discount of 40 to show, because she doesn't owe the 2,000. So we're getting rid of the 2,000 because she did it right. She did the cash appropriately. We debit the sales discount so we can balance, and we get rid of the entire accounts receivable because we made an agreement with her. She doesn't owe $2,000 if she pays it within 10 days. So even though she didn't pay the whole 2,000, we're telling her she didn't have to. Therefore, that's why we debit that sales discount. So then we can zero out the accounts receivable. She doesn't owe us any more money. So let's look, here's an example of what the income statement will look like with these different allowances, or what we call contra accounts. We start with our service revenue. We have sales revenue. Then we subtract for sales returns. We subtract for sales allowances. We subtract for sales discounts to come up with finally our net revenues. Okay. So after that, those different numbers, initially we were starting with $2,000. We had a credit sale of 200. or 2,400, 200. Then someone returned the $200 sunglasses. Then we gave her a $400 allowance because of she wasn't happy with the service. We collected the $1,960 plus the $40 sales discount, which was basically zeroing out her account. Now, what if someone doesn't take advantage of the discount period? Then we just ignore it. And in this case, they typically provide laser surgery for $3,000. The company's offering it for $2,400. And of course, this chick wasn't happy, and so she got the $400 reduction. They say, hey, if you pay within 10 days, you get a 2% discount. Otherwise, pay the whole thing within 30 days. Cash isn't collected from the customer until March 31st. So the discount's off the table. In that respect, we would just debit the cash of $2,000 and credit the accounts receivable of $2,000. Does that make sense? Remember, revenues are reported for the amount the company is entitled to receive. This amount equals total revenues minus either trade discounts, sales returns, sales allowances, and sales discounts. Now, okay, so we're going to stop 1 minute and we're going to work on a homework, or not a homework necessarily here, a question. Let's look here on example 5.3. On March 12th, Medical Waste Services provides services on account to Grace Hospital for $11,000. Terms 210, net 30. Grace pays for those services on March 20th. Record the service on account on March 12th and the collection of cash on March 30th. What do you think we're going to do here, guys?
Would you do cash for, let's see, 11,000 minus 220, and then you do, would you do a sales discount for 220 and then service revenue for 11,000?
Excellent. But let's first handle the first part of this question. The first part of the question says, record the service on account. So the first one we'll do is the service on account was 11,000, right? So wouldn't we right away do I want to get rid of those. Wouldn't the first thing we do is accounts receivable for 11,000 and service revenue for 11,000? That's the first transaction. Okay. The second transaction is exactly like you said. We'll have cash. We're going to have a sales discount, and we're going to credit our accounts receivable. So the cash amount is going to be how much?
10,780.
10,780. I'm just going to get rid of these. 10,780. The discount is 220, and this is 11,000. Does that make sense, guys? Yes, no?
I got it. Yep.
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 Okay. Now, let's look at one more problem. Exercise 5.6. On April 25th, Foreman Electric installs wiring in a new home for $3,500 on account. However, on April 27th, Foreman's electrical work does not pass inspection, and Foreman grants the customer an allowance of $600 because of the problem. On April 30th, the customer makes full payment on the balance owed. So the first thing we do is record the credit sale on April 25th. What will we record here, guys?
We record accounts receivable of 3,500 and then service revenue, 3,500.
Excellent. Accounts receivable, 3,500. Service revenue, 3,500. Then the next one says they were not happy.
So discount.
And so because they were not happy, record the sales allowance on April 27th. What will we do there?
$600. We're going to credit.
We're going to credit sales allowance for 600
Mhm.
and reduce our accounts receivable of 600 because they don't know that anymore, do they?
Nope.
Then record the cash collection. How much
So-
do they owe?
2,900.
Exactly. So we would show cash and accounts receivable,
Let's credit it.
2,900. Make sense?
Yeah.
Then it says, calculate net sales reported in the income statement. How are we going to show that? We're going to show it as sales, 3,500. And then we're going to do less sales allowances
600.
of 600
And
to
then
then show our net sales
29.
to be 2,900. Does that make sense? Are we good?
Yep.
Yep.
Okay, now we're going to go back. Now, sometimes we are going to need to make adjustments for these contra revenue accounts. The revenue recognition requirement says we need to report revenues equal to the amount of cash the company expects to get. Yes. Yes. That's why I'm recording it now. I recorded, it's on D, is it not on D2L? I'm so sorry. Let me do it right now, okay?
And they talking about chapter 4?
Chapter 5.
Oh,
I know, I'm so surprised I screwed up. That's a first. This minute.
20 years old, and I'm in a relationship.
Okay, let me do that real quick, guys. I'm really sorry. Okay. Okay, it's up. I'm sorry about that, guys. You see it? So the sales returns, oh, we've already done that one. Okay. Now let's look at this one. Which of the following computations would be used to compute net revenue? A, B, C, or D? Or total, is it total revenue plus accounts receivable minus sales discounts minus sales allowances? No.
I'm guessing C.
Excellent. Total revenue minus sales discounts minus sales allowances will equal our net revenue. Okay. Next, we're now going to talk about accounts receivable. Now, guys, I will tell you, people get real confused with this, but just really, this is the most important thing to stay focused on, this section right here. We're going to learn that not everybody's going to pay their bills. I know it's a shock, but it doesn't happen. But the reality is, for businesses, we should only recognize accounts receivable as assets in the balance sheet and report them at the net realizable value, which means what we really expect to collect. We know we should collect the full amount, but it's never going to happen. People do not pay their bills. So we are not allowed to overstate our assets. If anything, we need to have a conservative approach on our revenues and our assets. Therefore, we are going to create an allowance. Some receivables are just not going to be collected. So companies are required to estimate future uncollectible accounts and record these estimates in the current year. Now, what this does is it's going to reduce our accounts receivable asset, and it's going to also give us a bad debt expense in the year in which we make those revenues. Think about it. We're selling something today, but we might not get paid for it until in the future. We don't know who's not going to pay. But remember how we need to record our cost of doing business with the revenues they help to generate? So that bad debt expense, even though we don't know what it's going to be, we need to estimate it. So under the allowance method, companies are required to estimate future uncollectible accounts and record those estimates in the current year. Estimated uncollectible accounts will reduce our assets and increase our expense. The way we figure it, one of the most common is through what we call the percentage of receivables method. We base the estimate on bad debt expense on what we call the balance sheet approach. What are our accounts receivable? So how about this, guys? At the end of 2018, Kimsey is owed $20 million from customers. And it estimates that 30% of those won't be collected. So 30% of 20 million is $8 million. At the end of the year, we need to debit a bad debt expense, and we credit this new Contra account, I'm telling you, called Allowance for Uncollectible Accounts. What this does is it creates the bad debt expense in the year in which the revenues were earned, and it gives us this Contra account calling Allowance for Uncollectible Accounts, which ultimately is going to be offset with accounts receivable to reduce our balance. So in the income statement, we're going to see our bad debt expense. But in the accounts receivable, we're going to see a net accounts receivable. We're not going to collect all 20 million. Somebody's going to not pay us. So that's why we do this. In the year in which the services were provided, we create an allowance for those who aren't going to pay us. So our balance sheet with the accounts receivable has a realizable value of what we're really going to receive. So guys, look here, in 18, we sold 50 million. By the end of the year, we still haven't collected 20 million. We can't know who's not going to pay, but we can estimate based on past experience what the rates look like. So in this scenario, they estimate 14 million is going to get collected, but 8 million won't. That's how we create this Contra account. Adjusting for estimates of future uncollectible accounts matches our expenses, the bad debts, in the same period as the revenues they help to generate. Recording an allowance for uncollectible accounts correctly reports accounts receivable at their net realizable value. Guys, this allowance for uncollectible accounts has a normal credit balance. So people think it's a liability, but it's not. Remember, this is also a Contra account. It's a Contra asset account that's going to help offset accounts receivable. So which the following is true regarding allowance for uncollectible accounts? Don't say A, right? It's not a liability account.
It's C.
C, it's subtracted from the balance of accounts receivable in the balance sheet. Excellent. So another way in which we can estimate bad debts is look at the receivables, and you see those receivables that are not yet due. And then you see 1 to 60 days past due, 61 to 20 days past due, and more than 120 days past due. This is a more accurate approach to really estimate the bad debts, because guys, the reality is the older they go to be collected, the more likely it's not going to get collected. So in this example, do you see how those not yet due based on history, they estimate 10% won't be collected. Those 1 to 60 days, 30%, 61 to 20, 50%, more than 120 days, 70% won't get collected.
Question. How are they calculating to get that percentage?
Past history. So these companies have a history. They can look back and see what has actually occurred in prior years. So that's how they do it. The aging method considers the age of the receivables, knowing that older accounts are more likely uncollectible. It's going to be more accurate than just using one single method. So when you do this, you will debit the bad debt expense and you will credit the allowance for uncollectible accounts. Guys, what do you think? Which of the following is true about the aging method?
No.
I'd say D.
Yep.
Someone said D? Yes, older accounts are less likely to be collected. Using the aging method to estimate uncollectible accounts is definitely more accurate than just applying a single percent to all the accounts. Okay, so let's go back now and let's look at our book. Well, I can't do that yet. I don't. Okay, Physicians Hospital. No, I can't do that yet. Never mind. We'll keep going on. So how do we, so what we're doing previously is we're looking at the current year and deciding, hey, we need to estimate this. But now we're going to talk about how do we actually write off an account when it's bad, when we know we're not going to collect it. So when it becomes clear the customer's not going to pay, the company writes off the customer's account balance as uncollectible. What we do is we reduce the balance of accounts receivable by that particular individual's customer's account. And we're also going to reduce the balance of the allowance for uncollectible account. So ultimately, this has no effect on total assets or total expenses because we created that allowance. So when we actually have an account that's bad, we just write off their account and we debit our allowance. Remember, it's still keeping our accounts receivable at the same balance because we did the expense in the previous period. How about this one, guys? Kimsey receives notice that Bruce Easley's filed for bankruptcy and will not pay $4,000. Kimsey writes off Bruce's accounts receivable. We debit allowance for uncollectible accounts of $4,000 and we credit Bruce's account for $4,000. Okay. This just reduced the Contra asset account and it decreases our asset. But the effect on assets is zero. There's no effect on assets. People often think we need a, when we record a bad account, that we need to write off the bad account and then debit our bad debt expense. But we already debited our bad debt expense in that current year. The bad debt expense was recorded in a prior year at the time of estimating uncollectible accounts. Okay, let's now look at a problem. Okay. So during 2024, at its first year of operation, Pave Construction or Pave Construction provides services on account of 160,000. By the end of 2024, cash collections on these accounts total 110,000. Pave estimates that 25% of the uncollected accounts will be uncollectible. In 2025, the company writes off uncollectible accounts of 10,000. So the very first step we're going to do is record the adjusting entry for uncollectible accounts on December 31st, 2024. So what are we going to do here, guys? What we're going to do is figure out how much are we going to show is not going to be collectible. They said they provided services on account of 160 and they collected 110, right? So how much is left to collect?
60.
50,000.
50,000. And they're saying 25% of that 50,000 is not going to be collectible. So what are we going to do? We are going to debit our allowance for, excuse me, we're going to credit that. We're going to debit our bad debt expense for how much? 25% of 50 is what?
12,500.
Excellent. We debit the bad debt expense now, and we credit our allowance for uncollectible accounts of 12,500. In doing that, we are right now setting up the expense for what we anticipate to be bad debts, and we're crediting a Contra asset account that is going to offset our accounts receivable. So think about it this way. In our balance sheet, we show accounts receivable of 50,000. And then we have less allowance for uncollectible accounts of minus 12,500 to show net accounts receivable 37,500. See what we're doing? So then when it tells us record the write-off of accounts receivable in the next year, 2025, and calculate the allowance for uncollectible accounts at the end of 2025. It tells us in 2025, the company writes off uncollectible accounts of 10,000. What are we going to do when we write off those uncollectible accounts? We're going to debit allowance for uncollectible accounts of 10,000. We're going to credit accounts receivable for 10,000, right? But think about it, guys. I'm going to do a T account here. I'm going to do a T account here. This T account is going to say accounts receivable. This account is allowance for uncollectibles. We see here it was 50,000. You see over here it was 12,500. Okay. But then after we wrote off some accounts, do you see here we credited accounts receivable for 10,000? And do you see here, we debited our allowance for uncollectible of 10,000? Look what's happening, guys. Our ending balances on these accounts now, our accounts receivable is at 40. Our allowance for uncollectible is a $2,500 credit. So now it's at 40 minus 25. But guys, do we still balance? Do you see what we're doing? We took the bad debt expense in the year in which we made the revenues. We created this allowance. So when bad accounts actually happen, we've already adjusted for it in our books. So when we write off an account, we credit that allowance. It still didn't change anything, did it? Because one is an asset, the other is a contra asset, but our bottom line, our assets, our accounts receivable stay the same. Make sense? What if? Assume the same facts as above, but let's estimate that the actual write-offs in 2025 were 15,000, not 10,000. How would we do this different? We would make this 15. How about this? We would then make this 15. And how does this change this? Do you see now our accounts receivable is at 35,000? But do you see how our allowance for uncollectible is now at a debit balance of 2,500 when it really should be a credit balance? But do you see how we still balance? Does that make sense? Okay. Okay, let's move on. So Bruce, our guy who went bankrupt and couldn't pay, and we wrote off the account. Now it tells us Bruce later pays 25% of the amount owed. If we've written off account and we later realize, oh, they paid some, we reinstate the amount that they're going to pay. So we debit the accounts receivable, credit our allowance for uncollectibles, and then show our cash and reduce his account. Because sometimes that happens. So when writing off an uncollectible account, is bad debt expense debited? Is net income decreased? Are total assets unchanged? Is the allowance account credited? What happens here, guys?
Is it C?
Awesome. It is C. Nothing is affected. Total assets remain unchanged. Remember, when we write off a customer's account as uncollectible, it reduces the balance of the accounts receivable, but it also reduces the allowance for uncollectible accounts, which is the contra account. The net effect is that there is no change in the net receivable because the account receivable less the allowance is going to stay the same. We recorded the decrease to assets as a result of the bad debt when we established the allowance in the previous year. Okay, so now what we're going to talk about is what happens in the following year. So we are right now showing, oh, that's, we are right now showing the, excuse me, guys. We're in the previous year showing the bad debt, establishing our allowance. And then we are then recording those accounts that were uncollectible. Now what we're wondering is, after we've written off some accounts, how do we handle the next year? Using the aging method, Kimsey estimated bad debts in 2019 to be 5 million. But we actually only wrote off 4 million. In other words, we overstated the bad debts by 1 million. I mean, we're just doing the best we can guessing, okay? But in this case, we overestimated what we thought would be written off, and we were over bad debts. We overestimated by 1 million. But let's say the next year, Kimsey estimates bad debts in 2020 to be 8 million. How do we handle that? Well, how do we handle this 8 million? What we're going to do is we have a balance sitting in our allowance for uncollectibles of 1 million. But since we want the new figure for this year to be 8, we need to take into account that we do have 1 million that we overestimated from the previous year. So for this year, we're only going to show a $7 million debit to bad debt expense and a credit for uncollectible accounts. This is the key, guys. This 8 million will not be your journal entry. The 8 million tells you what they want the balance to be in the allowance for uncollectibles. But whatever the balance is in the allowance, we will plug in a figure that will be our journal entry based on what the balance is. Do you see how we're constantly playing catch up? We're estimating. Estimates are the best we can do. But if we go over our estimate, then the next year we'll take that into account and show a less of a bad debt expense. But if we go under our estimate and we actually had more bad debts than we expected, this figure wouldn't just be 8. This figure wouldn't just be 8 million, it would be more. And I'll show you what I'm talking about. So again, we show the bad debt in the income statement, and we show in the balance sheet our new balance of accounts receivable less our uncollectible amount. We want this number to be 8. But the bad debt expense may be different just based on what's already sitting in that allowance account. Here's the deal. What if actual bad debts in 2019 were 6 million compared to what we estimated the previous time of 4? Do you see how in this case we underestimated our bad debt expense? And we end up with a $1 million debit balance in here. So if next year we want this number to be 8 million, what's it going to take? What's the journal entry we need to put in here to take this 1 million debit? And what do we plug in to get 8 million as a credit? We would then have to show bad debt expense of 9 million. And we would credit our allowance for uncollectible accounts to be 9 in order to arrive at that 8 that we want. The key here is when we estimate in future years, that estimate of allowance is what the number needs to be in the balance, not what our journal entry needs to be. Okay? So when an entry is made to write off an uncollectible account, oh, we already did that one. Now, I am going to do another problem. Okay? Physicians Hospital has the following balances on December 31st, 2024. Before any adjustment, it tells us our accounts receivable 60, our allowance for uncollectible accounts is an $1,100 credit. Then it says on December 31st, 2024, physicians estimates uncollectible accounts to be 15% of accounts receivable. Record the adjusting entry for uncollectible accounts. Then determine the amount at which bad debt expense is reported in the income statement and the allowance for uncollectible accounts is reported in the balance sheet. And then calculate net accounts receivable reported in the balance sheet. I'm going to run to the restroom, and so I'm going to give you 4 minutes to figure this out. Okay? I'll be right back. Totally forgot to put my mask on. Did anyone attempt it? Anyone online attempt it?
I am still working on it.
I'll give you a couple more minutes.
Ms. Shoemaker, I'm gonna get off and I gotta get on through my phone now.
You bet.
Okay.
Okay, so let's look at this one. We're doing 5-8. Okay. So this one is going to be with already a balance sitting in the allowance for uncollectible accounts, which is what can be more challenging. So in the second year, Physicians Hospital has the following balances on December 31st, 2024 before any adjustments. Accounts receivable is 60,000 and the allowance for uncollectible is an $1,100 credit. So let's just do this up here. 60,000 and this is an $1,100 credit. Okay. $60. And this is an $1,100 credit. See what I'm doing? Does that make sense? Online, do you see what I'm doing?
Yes.
Yep.
Okay.
Yes.
Now, determine the amount at which bad debt expense is reported in the income statement and the allowance for uncollectible accounts is reported in the balance sheet. This is key. it tells us physicians estimate uncollectible accounts to be 15% of accounts receivable. What is 15% of this 60,000?
$9,000.
9,000. Do you see where I put that 9,000? They want this allowance for uncollectible accounts to now have a balance of 9,000. So what are we going to do to get a balance of 9,000? Aren't we going to say 9,000 minus the 1,100 because it's already sitting as a credit? Don't we need our bad debt expense to be 7,900? And our allowance for uncollectibles, the journal entry would be 7,900 in order to get this 9,000? Does that make sense? Yes? Yes, no?
Yes.
Remember, when they say, this is what we anticipate bad debts to be, and this is, you know, when we create that journal entry, that is not the journal entry. That is what we need our balance in the allowance for uncollectibles to be. And the journal entry gets plugged in based on what's sitting in the allowance account previous. Okay? Now, what would be the new accounts receivable net balance? It'd be 60 minus 9,000. Wouldn't our new net accounts receivable be 51,000 here? Do you see that?
So I see it, but just out of curiosity, so I minus the 1,100, was that including? So I'm guessing.
That 1,100 was the balance at the beginning of the year.
I just did an extra stuff.
Mhm. So what is different in this case is we already have a balance sitting in that allowance. We need to take that into account when we create our new allowance. Make sense? Remember, these are just estimates. So we write off that expense in the year we created the revenue, but we might do it more, we might do it less, we don't know. We just have to account for it appropriately. Okay, next, let me do another one. 5.9. Is this helping, guys, me doing these problems, or is it like too much?
It helps.
It helps?
It helps.
Southwest Pediatrics has the following balances on December 31st, 2024 before any adjustments. Accounts receivable, 130. Allowance for uncollectible accounts. Look at that, guys. A $2,100 debit. Okay, so let me go in here and put it. I'm sorry, I just forgot what I told you. What was the accounts receivable? 130 was the receivable. And this one, guys, was it a $2,100 debit? Okay. So let's just look at what that means. Our accounts receivable is 130. If we had a $2,100 debit, that means our net accounts receivable is sitting up here at 132.1 because it's a debit. Now it asks us on December 31st, 2024, Southwest estimates uncollectible accounts to be 20% of accounts receivable. What is 20% of 130,000? 26,000. What that means, this number here needs to be 26,000. So what are we going to do to get 26,000 here? Since this is a debit, don't we need to add these together? Wouldn't now our bad debt expense be 28,1? And our allowance for uncollectible, the journal entry is 28,1 in order to make this be 26,000. Do you see how we have to adjust? We just can't go in and say, oh, our bad debt expense now is 26,000, because in the previous year, we wrote things off. We might have overestimated, we might have underestimated. So we're always playing catch up. Make sense? Yes, no? The key here, you will not be frustrated if you remember when we do this allowance, when they say expect the bad debts or the allowance to be, or uncollectibles is going to be 20% of the accounts receivable. If you know, that means this bottom number is going to, we want that to be the new number. And we have to plug in whatever it takes to make it that. Okay? Because we're always playing catch up. Some years we're going to overestimate, other years we underestimate, but then we fix it for the next year. Got it? Calculate the net accounts receivable reported in the balance sheet. Well, won't it be $156? I'm wrong. This needs to be a negative. Won't it be 104? Yes, no?
I say yes.
Kind of getting it? Okay, let's move on. Now, contrast the allowance method and the direct write-off method when we account for uncollectibles. The direct write-off method really isn't gap used unless your uncollectibles are nil to none. When we do the direct write-off method, we only write off the bad debts when they're actually uncollectible. We don't use an estimate like we've been doing. We primarily just write off the bad debt when it occurs. Why this isn't good is because we're writing them off in another year, not in the year in which it actually occurred. Okay? Allowance account is credited for the estimate up when we initially do our estimate. When we have the direct write-off method, we do not have an estimate. Ultimately, the numbers stay the same, but it's just timing. We're supposed to show the bad debt expense in the period in which we earned the revenues. Some students think firms should reduce total assets and record bad debt expense at the time the bad debt actually occurs. Remember, we anticipate those future bad debts and we establish an allowance. The direct write-off method reduces accounts receivable and records bad debt expense at the time the accounts receivable proves uncollectible. If the credit sale occurs in a prior reporting period, then bad debt expense is not properly matched with revenues. Also, accounts receivable is going to be overstated in the prior period. So generally speaking, the direct write-off method is not acceptable for financial reporting. Okay. How about this one? On December 31st, before adjusting entries, a company's balance of allowance for uncollectible accounts is a credit of $2,000. What does a credit balance prior to adjusting entries indicate? The company did not estimate bad debt expense last year. The last year's estimate of bad debts was too low. The company's estimate equals actual bad debt expense, or last year's estimate of bad debts was too high. What do you think?
Is it D?
Excellent, it's D. It was too high. In other words, we didn't use up because we still have a credit balance sitting in there. Okay, how about this one? On December 31st, before adjusting entries, a company reports the following balances. We have accounts receivable, 100,000. An allowance for uncollectible accounts is a credit of 2,000. If the company estimates bad debts to be 20% of accounts receivable, what would our adjusting entry be?
Is it D?
Think again. It would be A. Think about it. If we've got, here, let me do it this way so you can
Oh.
see. If we've got, what is this, 100,000? And what was sitting in here? $2,100 debit. No, I'm wrong. The PowerPoint says a $2,000 credit. Okay, so this is a $2,000 credit. They want our estimates to be 20% of our accounts receivable, which means they want this number to be 20,000. What journal entry do we need to show to get us here? Doesn't this need to be
18,000.
18,000?
Yep.
Guys, the most important thing to remember is that's not the journal entry. That percent, what they're telling you, needs to be your balance in the allowance for uncollectibles. Okay? Okay. Now, notes receivable are often need to be recorded. Companies will lend money similar to accounts receivable, but usually notes receivable are a written agreement. Okay, so classified as either current or non-current asset, depending on when it's due. So you see here, a note receivable has a couple doc items: the face amount of the note, the due date, the payee, the interest rate, and the maker of the note, along with the date of the note.
I have a question.
Yes,
What does face value exactly mean?
just what they're lending money to a customer. The face value is the amount they're going to be due.
Okay, thank you.
Yeah, so it's like if you borrow money to buy a loan, and your loan, or if you borrow money to buy a car and your car is 28,000, but you borrow 26, the face amount of the note is 26. Okay. So Kimsey provided $10,000 of services to Justin Payne, who isn't able to pay back immediately. Justin Payne signs a promissory note offering to pay $10,000 plus 12% interest in 6 months. So what we'll do here is we'll debit notes receivable and we credit our service revenue. Then when they pay the loan off, we don't record interest right away because we haven't earned any interest yet. But when the loan gets paid off is when we'll record, in this case, because it's under a year, we'll record our interest. So when we finally collect the note, we will show our debit to interest revenue for $10,000 times a 12% interest rate times 6 months out of 12 months. We'll show our full notes receivable of 10,000 and we debit our cash for the full amount. Remember, we want to keep track of our interest by each year. So in 2018, if this note was issued in November 1st, at the end of the year, we would want to show interest revenue for 2 months. And even if the note doesn't get collected until May 1st, we need to show in 2018 what we earned in 2018, and we would show it as a receivable. So in this case, 2 months of interest revenue is earned in 2018, and 4 months is earned in 2019. So we would show interest receivable. We didn't get the money yet. We're going to get it. And interest revenue. And then when we finally do receive the money, we'll show cash of the entire amount. We'll credit our interest receivable of what we were to receive in 19 or 18, and then interest revenue for 19. Guys, let's look at this one. I want everyone to attempt this, please. You guys know what to do here? So it shows here the company accepts a note receivable of $5,000 on September 1st that matures in 10 months and has a stated interest of 6%. What amount of interest revenue will the company record in 2018 and 2019? What do
Is
you
it
think?
A?
A.
A, excellent.
Can I just ask how you guys did your formulations on this one?
Absolutely. So it happened September 1st, which means 4 months. So $5,000 times 6% times 4 months out of 12 months. Because remember, it's always annual. 6% is an annual amount.
Okay, yeah, that's where I got it wrong, the 4 out of the 12.
Yeah, okay.
Thank you.
So instead of doing 10 out of 12, did you do 6 out of 12?
Because how many months are in a year?
12.
Correct.
My question is, because I did 10 divided by 12 instead, should it have been,
Well, it is 10 months in all, but they want us to know how much is going to be reported in 18, how much is going to be reported in 19. So because September, October, November, December, because there's 4 months in 2018, we need to show those 4 months. And then we need to show 6 months in 19.
okay, and that's where I go to.
Yeah. Okay, so these key ratios I want you guys to do on your own. You will have a homework problem about it, and you will have some a test question about it, just so you know that, okay? The receivables, well, I'm gonna let y'all do those on your own. Now, the last thing I want to have you look at is when we estimate uncollectible accounts using the percentage of credit sales method. There are 2 ways to figure out uncollectibles. What we just talked about was the balance sheet approach, where we used accounts receivable. Other people will use, it's not common, but will use the sales method, which we call the income statement method, because sales is on the income statement. And this adjusts the allowance for uncollectible accounts for the current year's sales. This one's easier to do because we're not focused on accounts receivable, and we don't have to keep track of, making sure our balance is correct. This one is just about showing a debit to bad debt expense, and we'll credit our allowance for uncollectible accounts based on sales only. We don't care what the ending balance needs to be for the allowance for uncollectibles. By the end of 2019, Kimsey has accounts receivable of 30 million, allowance for uncollectible accounts of $1 million, and credit sales for 80 million. They're telling us under the credit sales method, we're going to estimate 12.5% of credit sales to be uncollectible. If we did the percent of receivables method, we estimate 8 million of the ending accounts receivable to be uncollectible. So that's why we have to, plug in the number into the allowance for uncollectible accounts. But using the credit sales method, what we do is we just take 12.5% of sales, or 10 million. We debit our bad debt expense. We credit our allowance for uncollectible accounts. Since we're using sales, we don't have to keep updating our allowance for uncollectible account. We just show bad debt expense 10 million, allowance for uncollectibles 10 million. Using the percentage of receivables method, we have to always adjust our allowance for uncollectible accounts because it's directly linked with our receivables. See that? But no, when you use the sales method, you don't have to go through that work. So on December 31st, before adjusting entries, a company reports the following balances: accounts receivable, 100,000, allowance for uncollectible accounts, a $2,000 credit, and credit sales are at 500,000. If the company estimates bad debts to be 4% of credit sales, what would our journal entry be if we're using the credit sales method? Anyone? Come on. Wouldn't it be pretty easy, guys? Wouldn't it just be 500,000 times 4%? We will debit bad debt expense to 20,000 and we credit our allowance for 20. When it's the sales method, we don't keep that allowance accurate because we're just doing it based on sales. When we're doing it based on receivables, then that's a different story. The amount that we're going to show uncollectible is the bottom balance, and we need to plug in for the figure. Any questions, guys? So I want to go through the homework real quick. Okay, you guys cool with that?
Yeah.
Homework. So, I So come on. The email and password, Nancy may. Are you kidding me? There, I don't know what I was in. Oh my God. I feel like I'm going crazy. I just got into that account earlier.
It said you're locked out now.
Are you kidding me? My goodness. That is the account. And Shoemake at shoemakecpa.com. Okay, I feel like I'm going crazy. This has happened to me, guys, 3 days in a row. And it makes no sense to me what's going on. Oh, create a new password. Okay, homework. Oh, let me